Let's kick off with the first one today. We've got data released over the European session.
Okay, well, it would be remiss not to just flag what we just talked about. Again, the big movement in Chinese equities. Shanghai Composite Index was down 6.2% overnight. And as I understand it, that was even as the People's Bank of China added liquidity to the system, not specifically to the equity markets, but to the money markets as a whole. But it just shows you, however good your propping up of a market is, it will inevitably find its own natural level.
Yep.
And that appears to be what's happening here. That will rumble around the world for a while yet. Staying in Asia and staying with stuff that happened before the European Open, we had new vehicle sales in Australia. Obviously, new vehicle sales in China and America have been key to European car makers, but it's also important for them to see growth in other developed economies such as Australia. So for the figures for July, month on month, actually down 1.3%, contrasting with a healthy 3.8% gain over the previous months. Looking at the history of this monthly figure, is very erratic. It swings, either side of the gain line very regularly. Okay. So it's probably better to try and get a handle on what's happening on a year-on-year basis. Well, the trend is down slightly still. 3.7% the growth year-on-year in July of new vehicle sales. And that was weaker by just 7-8% than the prior read of plus 4%. So the questions about the Australian economy remain. It's obviously under a lot of pressure, thanks mostly to China and weaker commodity prices and the strong US dollar, I should say. So again, those are the kind of numbers that people will be watching going forward. And then back into Europe, it was a pretty thin day for data from mainland Europe, but we had plenty to contend with looking in the UK, particularly inflation data, and a whole raft of numbers here. I picked out a few of them and I hope I won't bore people running through the lot. First of all, producer price inputs year on year, down 12.4%. Sounds dramatic, doesn't it? But the forecast was down minus 12.8%, so we beat that. We're also ahead of the prior read of minus 12.6%. But not surprising really that the input prices are down for a lot of the reasons we just talked about. Commodities, have fallen sharply. And that's the factor behind that. Has that translated into output prices as far as producer prices are concerned? Well, to some extent, yes, it has. Producer prices on the output side fell by minus 1.6%. That was actually slightly worse than the forecast minus 1.5%. And the prior figure, which was exactly the same, minus 1.5%. And then the two numbers that
the headline makers.
Yes, that most people focus on. Firstly, core CPI. So this is the tighter measure of consumer inflation. And that was at 1.2% against the forecast of plus 0.8%, and indeed the prior read of plus 0.8%. So that set pulses racing. The broader measure of CPI, though, was a bit less compelling, plus 0.1%, though better than the forecast unchanged in the prior read of 0 as well. So net cable, as we'll see later, has taken heart from that and has rallied on the back with the expectation of a rate rise coming sooner rather than later. I think that fades personally, because I don't think the data's strong enough to justify that yet.
Understood.